They say that if you want to be happier than the typical American, then you need to make a minimum of $85,000 per year. However, let me ask you, how much money do you really need to invest to earn that much money without ever having to work again? Is $85,000 enough so you'd have a comfortable life and the freedom to choose how you spend your days? Instead of rushing to work in the morning, why not sleep a bit longer or enjoy a relaxing day in the park? You could accomplish that if you had $85,000 per year coming in without having to do anything. In this video, we will explore how much money you need to invest so you can retire but still receive at least $85,000 per year without needing to work. Stay tuned because we will also discuss various tips and recommendations to help you achieve this goal. So make sure to watch this video to the end. This is Financial Intellect, where we promote that to be finance savvy, we are your buddy. Now let's get right into the video. The connection between money and happiness was investigated in a survey of over 33,000 employed people in the United States. The study discovered that $85,000 per year was the tipping threshold for happiness. Those earning less than $85,000 are less happy than the ordinary person, whereas those earning more than $85,000 are generally happier. When you have disposable income, you can spend it on products and experiences that you want, rather than spending it on essentials. Although retired households spend an average of $3,800 per month, making ends meet on such a small income can be difficult at times. This could mean living in a less than ideal location, skipping activities, and weighing each purchase carefully. Those who earn at least $85,000 should theoretically have fewer money problems and be able to indulge frequently enough to keep them satisfied. To begin, figure out how much of your portfolio you may withdraw each year. You want this sum to be long-term with little to no risk of running out of cash. According to a study, a 4% annual withdrawal from a stock and bond portfolio is safe. Despite the fact that the study was completed in 1998, it still remains a useful reference because it considers a variety of market scenarios. This strategy will work even if you retired when the market was performing poorly or if the market has been flat for a long time. It also takes into consideration the annual inflation adjustments so that your purchasing power remains constant during your retirement. Alternatively, some people choose a dividend retirement approach since they may live off the dividend income instead of relying on capital gains. A realistic retirement strategy would provide 3 to 5% of the value of your investments as well as annual income. Using the 4% withdrawal rule, you will need exactly $2,125,000 invested to earn $85,000 every year. It's reasonable that most people are surprised when they learn how much money they'll need to attain their financial goals. How can a regular individual with an average income save over $2 million? However, when you break down the numbers, you'll realize that it's easier to achieve than it appears. When you invest over time, compound interest will make up the majority of your portfolio, not the money you put in yourself. You'll be shocked at how quickly your investments will grow and snowball. Even if you have no money to invest, you may still build a portfolio worth more than $2 million. Remember this, you will have nearly $2,200,000 if you will just invest $1,000 every month or $12,000 per year for 30 years. This is of course based on a 10% average rate of return, which is the S&P 500's historical average. With a long-term attitude and some perseverance, $12,000 per year is just a small amount of money to set aside to attain that goal. In the United States, the median household income is $62,000. Saving $12,000 equals only a 19% savings rate, which is appropriate given that numerous financial experts recommend saving 15 to 20% of your salary. But if you're passionate about achieving your goals, you need to make certain compromises in order to save an even bigger percentage of your income. If you can't achieve it with your existing expenditure, you'll probably have to downgrade your lifestyle. You could get there sooner if you start investing now and are ready to save more than $12,000 per year. Starting with nothing and investing double that amount per year, you'd have around $2,200,000 in 23 to 24 years. Even though the savings amount has doubled, it doesn't mean it will also take half as long to reach $2,200,000. This is due to the fact that compound interest grows stronger over time. As a result, portfolio growth is given mostly by time invested rather than actual contributions. 30 years may seem like a long time before you can earn that $85,000 each year without working. When you're starting out in your profession, that also feels like an eternity, but it goes by far faster than you think. The average American retires at the age of 64, which implies that they have worked for well over 30 years. If they started working at the age of 18, that means they worked for 46 years of their lives, excluding any vacations. Even if they go to college for 4 years, they will have worked for 42 years. That's a long time in comparison to 30 years. Those people that successfully saved and invested enough don't have the mindset of, "I'll probably be gone by then." I know it's difficult to get excited about waiting 30 years to earn this much money, but obtaining higher returns is a viable option that can help you get there sooner. Rather than investing in the S&P 500, consider a growth index which has a better overall return. The S&P 500 index contains a diverse range of large blue-chip companies, but many of them do not grow at a rapid pace, limiting your overall return. Over time, a growth fund that is specially structured to deliver higher returns would outperform the market. It's crucial to remember that while growth funds have a larger risk, they also offer better rewards over time. As a result, investors with a long time horizon should invest in a portfolio that emphasizes growth. Real estate can produce profits that are greater than those earned in the stock market. Real estate can yield superior returns for a variety of reasons, but it does involve more effort. The key reason for these higher returns is that banks will give you money to buy real estate since it is a secure, tangible asset. This permits you to take advantage of leverage by borrowing money from the bank. Rental property can yield a 10% or greater cash-on-cash return, and that's only one source of income. Though there's no doubt that finding and managing property takes more effort than just pressing a few buttons to buy equities, the benefits, however, may outweigh the additional effort. Consider that $85,000 is an average, and how far that money will stretch depends on a number of variables. For someone living in a large city, money will not stretch nearly as far as it will for someone living in a low-cost area. Thus, it's also crucial to think about your spending habits. Spending money on experiences that match your ideals increases pleasure, while succumbing to lifestyle creep does not. Living within your means is a crucial notion that leads to increased happiness because it teaches you to be content with where you are. Spending less than you earn and having a little breathing room will help you feel less stressed. However, it's a popular misconception that the more money you have, the happier you will be. This isn't always the case. But knowing that some people who earn $85,000 or more are often happier is also understandable, as they can relax, knowing that they won't have to pinch every penny. So although money cannot purchase happiness, it can, however, alleviate the stress of worrying about how to pay the bills. And those are some suggestions on how you can achieve that $85,000 per year return so that you can be financially free and secured, which may result in more happiness and contentment. What are your thoughts on this? Do you agree with these? Let us know in the comment section below. We'd love to hear your thoughts on this. And with that, thank you very much for watching. If you like what you've watched, stay tuned for more videos. Bye, financial buddies!